All right. Well, good morning, everyone. Thank you for joining us for this session. And I believe it was a similar fall day in 2019 when a similar group assembled for our last forum that we held in Jersey City. And I was in attendance at that forum, and I've always looked forward to being here again. So I'm very happy to be here with you today. And I guess maybe as just kind of a quick show of hands, how many people were here in 2019? Just real quick. Oh, thank you. There's quite a few in the room. So I'm glad that you're with us again. And then I know on the live stream we have a number of individuals that have dialed in or connected to participate in that way. And so just real quick, my name is Tim Sykes. I'm a deputy director based in our Dallas office. And I serve as the program leader for the non-affiliated firm program within our Division of Registration and Inspections. I'm pleased to present this session today of our Small Business Forum along with a couple of my colleagues from the New York office. To my left is Nick Jenner, who is an inspection leader in New York, and then Shirley Wee is also joining us, who is an associate director from New York. And so as I begin, let's see if we can, I can't see that actually. We go to our disclaimer. And so I know this has been mentioned a couple times, but I do want to remind you that the views we express today are in our official capacity as members of DRI, but they are our own and do not necessarily reflect the views of the board members, or other members of the staff. In keeping with our CPE process, the next CPE code is 664. So I'll give you a moment to enter that and record that so you will be eligible for CPE credit. Again, 664. All right. And then moving on to our objectives. We're going to cover a number of things today, and I will be covering the first couple of topics, and then we will have participation from Nick and Shirley. And so just to provide you a brief update, I'm going to cover information related to our inspections that were conducted in 2023. And then also I'll provide some information regarding our current inspections in 2024, which is, as you know, are currently underway, and we have made good progress in that area given we're here in the final stretch of 2024. And then Nick will take us through a deeper dive and discussion around auditing and accounting estimates, including fair value measurements. And then finally, Shirley will discuss audits involving other auditors. Nick and Shirley will share with you the relevant audit requirements, and they will provide some examples of the audit deficiencies we have found in these areas. They will also describe some good practices for your consideration. So let's get started. As it relates to our 2023 inspections, the PCAOB inspected 227 audit firms, reviewing portions of 793 public company audits that generally had fiscal years ending during 2022. In recent years, a significant trend in inspections has been the rise in deficiencies among audit firms. This negative trend persisted into 2023. However, there has been a stabilization in the aggregate deficiency rate for the Big Four firms, along with improvements in the rates for several other annually inspected firms. Moreover, a detailed analysis indicates that there are some outliers that are significantly impacting the overall deficiency rates. In 2023, the aggregate deficiency rates have continued to increase across all inspection programs, and 46% of the engagements reviewed in 2023 had at least one Part 1A finding. A detailed examination of the 6 U.S. global network firms, we refer to as the GNF firms, shows that outliers are significantly impacting the overall Part 1A deficiency rate in that category as well, which stands at 34%. Similarly, outliers are also influencing the deficiency rate among our annually inspected our U.S. non-affiliated firms, where the aggregate Part 1 deficiency rate reached 51% in 2023. It's important to point out, however, that this aggregate rate does not necessarily represent the audit quality of individual firms, because within this category of our annually inspected NAF firms, some deficiency rates are close to 10%, where on the other hand, there are other deficiency rates that are in the neighborhood of 80 to 100%. So you can see there is a pretty wide difference in the results that we're seeing from our inspections. And then to speak a bit about the NAF triennial firms, over half of those firms during our inspections showed no significant changes in Part 1A deficiency rates compared to their previous inspection. In addition, 26 of the 82 NAF domestic triennial firms previously inspected in 23 experienced an increase in their Part 1A deficiency rates. Only 5 of these firms saw a decrease in their expected deficiency rates. Various factors such as mergers, an increase in issuer audits, a focus on regional banks, all of these things may contribute to these findings. Simply put, however, audit quality at the triennially inspected firms is not improving quickly enough, and the rise in Part 1A deficiencies demands immediate attention from those firms. So let's see, we should have a polling question now. And this question, which I hope you can see on the screen, is which audit area has not been included in the illustrative examples during this session at a previous forum? I'll give you a moment to respond to that. I can't tell, is there a counter on that?
Yes, there is. It's up to about 100.
Okay, let's give it a moment. We're up to about 100. We'll give it a moment for others to record their response.
You're at 200 now.
Okay. All right, so 30 more seconds. Okay, well, let's see if this takes us to the results, and the correct answer is A. Auditing and accounting estimates has not been included in the illustrative examples at a forum before. However, it will be discussed today, along with illustrative examples of audits involving other auditors. All right, so moving forward, I'd like to discuss some more information around 2023 common deficiencies. And in particular, I would like to focus my comments in 2 general areas. The first is the testing of internal controls over financial reporting, or ICFR, and the second is around certain financial statement areas. And so as it relates to the 2023 results for ICFR, we have found that these deficiencies remain a common occurrence in both integrated audits and when controls are tested in a financial statement audit. In that regard, we have noted 4 areas of common deficiencies related to testing of internal controls over financial reporting, or ICFR. The first of these is related to risk assessment. One example that staff observed related to risk assessment and the audit of internal controls is as follows. The engagement team did not reevaluate and revise its initial risk assessment after it obtained audit evidence during the audit that contradicted the audit evidence upon which it had originally based its risk assessment. The next common area is related to selecting controls to test. An example of a deficiency noted for smaller reporting entities related to selecting controls to test is where the engagement team did not identify and test controls that address the risk that the same individual would prepare and post journal entries in the general ledger without approval. Another common area of deficiencies in testing controls is the test of design effectiveness. The following is an example of a deficiency in this area. It's the engagement team did not sufficiently test the design effectiveness of a control because it did not evaluate the effect of incomplete information available to the control owner, and as such, the ability of the control as designed to effectively prevent or detect a material misstatement. The fourth area that we see deficiencies in testing internal controls is testing management review controls. Verifying that a review was signed off provides little or no evidence by itself regarding the control's effectiveness. An example of this type of deficiency observed by our staff is where the engagement team did not evaluate the specific review procedures the control owner performed to evaluate the reasonableness of the projected amounts for revenue growth and cost that the public company used in its impairment analysis. Deficiencies in auditing internal controls over financial reporting remained high, and auditors are encouraged to continue to focus on auditor performance in these areas. Next, we will discuss some common deficiencies observed in certain financial statement areas. The first area is revenue and related accounts. Revenue is a frequently selected focus area in our inspections, given, among other things, the complexities associated with revenue recognition accounting policies and practices, and the complexities associated with the auditing of such policies and practices. The following are 3 examples of some deficiencies the staff has observed. First, the engagement team did not perform any procedures on significant assumptions and a percentage of completion basis of revenue recognition. The second, the engagement team did not test the accuracy of historical data used in testing procedures related to current year transactions. And the third is the engagement team did not select a sample that could be expected to be representative of the product revenue population. The second area is inventory. Inventory can often present a significant risk of material misstatement due to the complexities of determining the cost of inventory and measuring inventory on hand at a point in time. Examples of deficiencies in this area are where the staff observed the engagement team did not perform any procedures to test the accuracy and completeness of the period-end inventory listing reports and the completeness of the physical inventory adjustments that were used in testing the existence of inventory. Another example is where the engagement team did not perform appropriate procedures to test movement of inventory between the interim date and period end. And this is important where you have inventory observations that are not inventory observations that occur on a date other than the period and date. This is oftentimes referred to as the roll forward period. The next area that we have found deficiencies is related to accounts impacted by business combinations. Business combinations by their nature impact many accounts and include a broad spectrum of accounting estimates, including fair value. A couple of examples of deficiencies in this area include the engagement team did not perform sufficient substantive procedures to test the valuation and allocation of purchase accounting, including forecast information used in valuations, or where the engagement team did not perform sufficient substantive procedures to test other significant aspects of the acquisition agreement, such as contingent consideration. And finally, as it relates to other financial statement areas, I'd like to mention investment securities. Investment securities usually represent the second largest asset class for banks. In this area, the staff have observed examples where the engagement team did not perform sufficient substantive procedures to test the presentation and disclosure of the fair value hierarchy in the notes to the financial statements. The second example would be the engagement team did not obtain an appropriate sample for testing the investments that could be expected to be representative of the population. And the third item here would be where the engagement team did not perform any substantive procedures to test assumptions used in the valuation of investments. So that takes us, I believe, to the next slide. And on this one, we'll shift gears a little bit. I've covered and if you're familiar with our inspection reports, my comments so far have been related to Part 1A findings. And now we'll shift to other parts of the inspection report. And so in this category, what we call within our reporting structure, Part 1B matters, and then I will also talk about the system of quality control, which is commonly known as Part 2. As it relates to what we call Part 1B matters, these represent deficiencies that are related to the PCAOB standards and rules. And I'll mention actually 5 areas in this category for your consideration and information today. The first area is fraud and journal entry testing. Material misstatements of financial statements due to fraud often involve the manipulation of the financial reporting process by recording inappropriate or unauthorized journal entries throughout the year or at period end. And then the second category would be around making adjustments to entries reported in the financial statements that are not reflected in the individual journal entries themselves. In this area, we have observed deficiencies where the engagement team did not support its rationale for limiting its testing to only certain journal entries that met its identified fraud criteria. Another example where the engagement team did not include in its journal entry testing entries that actually met their identified fraud risk criteria. And then another example would be where the engagement team did not examine the underlying support for certain journal entries identified based on the risk criteria. The second area I would like to mention, or that I will mention, is related to critical audit matters, or CAMs. An auditor's communication of CAMs in the auditor's report is intended to inform investors and other financial statement users about any matters arising from the audit of the financial statements that were communicated or required to be communicated to the audit committee and that relate to accounts or disclosures that are material to the financial statements and involve especially challenging, subjective, or complex auditor judgment and the auditor's response to those matters. The deficiencies we have found primarily relate to instances in which audit procedures to determine whether or not matters were CAMs did not include every matter that was communicated or required to be communicated to the issuer's audit committee, and that related to accounts or disclosures that were material to the financial statements. These instances of noncompliance do not necessarily mean that other CAMs should have been communicated in the auditor's report. We also observed in limited instances within the program where some auditors performed no procedures regarding CAMs. And then as Board Member Thompson mentioned a moment ago, last week we debuted a new series of staff publications tailored to auditors of smaller public companies called Audit Focus, where we aim to provide brief and actionable insights for auditors. Each edition of Audit Focus reiterates applicable auditing standards and our staff guidance and offers reminders on areas of common deficiencies. And as you may have noticed, our very first edition of this publication was on CAMs. So I would encourage you, if you have not already done so, to take a look at that publication, and I think you will find, and I hope you will find it helpful. And what we plan to do is we'll start a series of publications on topics such as this, and they will be posted on our website. Now, moving through the third area that I would like to cover quickly is around auditor tenure. We continue to see and identify deficiencies in auditor reporting for the year the firm began serving consecutively as the public company auditor. This standard's been around for a while, but we're still seeing deficiencies in this area, and I would like to remind practitioners to keep this in mind as they conduct their audit procedures. The fourth area is around audit committee communications. Deficiencies broadly ranged across all firms in this area, and we have observed examples where the auditor did not communicate to the public company audit committee on the following matters. The first would be they failed to communicate an understanding of the terms of the engagement in an engagement letter and determined that the audit committee had acknowledged and agreed to the terms of the engagement. The second item would be the significant risks that were identified during its risk assessment procedures were not communicated. And then the third item I would note is that critical accounting estimates and related significant assumptions that had a high degree of subjectivity were also not communicated. And then the last topic in this area that I would like to cover is around Form AP reporting. 2023 was the 6th year of execution for this requirement. And we believe firms should be familiar and experienced with this process. Although we have seen improvement in this area in 2023, we still see deficiencies related to Form AP in approximately 10% of the issuer engagements we reviewed. And so we would like to remind practitioners as well to focus in this area to improve the quality of the reporting that is required. So that covers Part 1B. So let's move now to the QC system. As part of its inspection process, PCAOB inspection teams conduct quality control reviews to assess a firm's system of quality control. This assessment includes evaluating whether identified deficiencies in individual audits indicate a defect or potential defect in a firm's system of quality control. The following are 3 areas where we have observed deficiencies in testing a firm's system of quality control. First, in the area of independence, we continue to identify SEC violations of the financial relationship requirements. These potential violations, mainly with NAF triennially inspected firms, include financial relationships, employment relationships, business relationships, non-audit services, contingent fees, and audit committee administration of the engagement. As it relates to independence, I will refer you to our website for a spotlight entitled Inspection Observations Related to Auditor Independence, which was published in September of this year, and this document will provide more information on the deficiencies we have observed in this area. The second area is engagement quality review. We continue to identify deficiencies in the engagement quality review in many of our inspections. The deficiencies are not limited to a single type of deficiency or a single type or size of firm, nor are they limited to a specific type of engagement. The deficiencies observed range from the firm not obtaining the required EQR at all, or perhaps performing the EQR with due professional care. And as it relates to EQR, I will also refer you to our website for another spotlight document that's titled Inspection Observations Related to EQR, and this document was published in October of 2023. The final area I would like to cover related to QC findings is monitoring. Firms, based primarily on size and structure, utilize a variety of methods to ensure that the quality control policies and procedures established by the firm are suitably designed and are being effectively applied. Monitoring involves ongoing consideration and evaluation. Many firms' documented systems of quality control indicate aspects of the monitoring is performed through internal inspection programs. This typically occurs, as you know, after the release of the audit report, so it's effectively a post-issuance review program. The staff has observed deficiencies in this area for engagements selected for review, where a firm performed monitoring procedures or an internal inspection on that same engagement. However, when we performed our inspection, we noted instances where the firm failed to identify the same Part 1A deficiencies identified by the PCAOB inspection team. And again, there is another spotlight that I would like to highlight that covers many of the topics that I've covered this morning. And this is the spotlight titled Staff Update on Inspection Activities, which was published in August of 2024. And I believe it's time for another CPE code. And that code is 858, and I'll give you a moment to record that. So 30 seconds, code 858. And we will move on to talk a bit about our 2024 inspections. So having covered quite a bit of content regarding our 2023 inspection results, let's turn our attention to 2024, which are currently underway. Many of our inspection plans for this year were presented in our spotlight, staff priorities for 2024 inspections and interactions with audit committees that was released in December of 2023. I will focus my remarks here on just a few key features from that publication, but I would encourage you to refer to that document for more detailed information. Our 2024 inspection program considered overall business risks present in the audits inspected. A few of these business risks include persistent high interest rates, tightening of credit availability, and/or inflationary challenges, disruptions in the supply chain and rising cost, business models that are significantly impacted by rapidly changing technology, geopolitical conflicts, and financial statements that include areas with a higher inherent risk of fraud, estimates including complex models or processes, and our presentation and disclosures that may be impacted by the complexities in the public company's activities. It's important to note that we continually also work to improve our inspection program. We use a data-driven and a risk-based approach with a focus on riskier engagements. Some of the enhancements we have made to our 2024 inspection program include a couple of things. The first is increasing the number of engagements reviewed. In 2024, our efforts in this area were focused on enhancing investor protection, and we increased the number of engagements that we selected for review at certain annually inspected firms in response to heightened risk in certain industry sectors. A second area would be the expansion of inspection procedures. In 2024, we continue to perform inspection procedures on every engagement that we selected for review to assess compliance with certain aspects of the auditing standards required to a number of areas, including independence, fraud, audit findings, audit committee communications, Form AP reporting, the auditor's report, engagement quality review, and audit documentation. A third area where we made some changes was to increase our focus on a firm's culture of integrity and audit quality. Audit firms continue to face challenges delivering quality audits, as evidenced by the increasing trend of audit deficiencies in recent years and deficiencies identified that have recurred for numerous years. We are interested in why these deficiency trends are not improving and whether audit firms' cultures are playing a role in this failure to improve. And the final area of focus for 2024 was around increasing the timeliness of our inspection reports. Considering the recommendation of the PCAOB's Investor Advisory Group, we took additional steps to streamline our internal processes to enable more timely issuance of inspection reports. As you may be aware, on August 15th of this year, we published the 2023 inspection reports for the 6 GNF annually inspected firms. This publication in August was several months sooner than they have been posted in recent years. In addition, we have made significant progress in publishing the NAF triennial inspection reports in record time throughout this year. Beyond these selection factors that I've mentioned in 2024, we place continuing emphasis on selecting audits of public companies and industries and sectors with specialized accounting and/or that were negatively impacted by uncertainties and volatility in the economic and geopolitical environment. And so at this point, we've covered quite a bit of material related to 23 and 24, and so I will transition now to Nick, who will provide us an update around estimates and the use of specialists. So Nick, I'll hand it over to you.
Okay, thanks, Tim. As Tim just mentioned, we will go through illustrative examples for 2 areas in which we saw deficiencies in 2023 non-affiliate firm inspections. I'll cover auditing accounting estimates, including fair value measurements, and my colleague Shirley, we will cover audits involving other auditors. The intention is to discuss what the standards require, common deficiencies that were encountered from the 2023 non-affiliate firm inspection program, and good practices we observed. So what are the key aspects of the estimate standard? First, it applies to accounting estimates in significant accounts and disclosures. And at a high level, it focuses the auditor on estimates with a greater risk of material misstatement. And this is done through explicit integration of the requirements of the standard with the board's risk assessment standards. It also emphasizes the application of professional skepticism, including addressing potential management bias. This is important given the subjective nature of many accounting estimates. Another key aspect is that it includes 3 approaches to substantively testing estimates, and we're going to get into that in a little bit. Finally, the standard provides direction on auditing fair value measurements of financial instruments, particularly when pricing information is obtained from third parties. But given the interest of time today, we're not going to deep dive the particulars of that portion of AS 2501, but there is an appendix in AS 2501 devoted to that. Finally, I just want to mention that in connection with AS 2501, you may also have the contemplation in your audits of use of specialists. And depending upon the nature of the specialist, the requirements would reside in different portions of our standards. If you were to use a company specialist, whether company engaged or company employed, the requirements of that would reside in Appendix A of AS 1105. If you were to use an auditor employed specialist, the requirements of that would reside in Appendix C of AS 1201. And if you were to use an auditor engaged specialist, engaged implying hired from the outside, the requirements would reside in AS 1210. So as I just mentioned, there are 3 approaches to testing accounting estimates, and the auditor may use any one of these 3 approaches individually or in combination. Those 3 approaches are testing the company's process, developing an independent expectation, or evaluating evidence from subsequent events or transactions. However, the auditor's decision about the approach he or she takes to auditing accounting estimate should be informed by the auditor's understanding of the company's process used to develop that accounting estimate, and, if relevant controls are tested, the results of those tests. So you're probably wondering, what are some of the things we should be thinking about when selecting a substantive testing approach or approaches? Well, there's not one size fits all in terms of this contemplation. How you determine which approach or approaches to use will be informed by several things. So let me just go through a few examples and considerations. Testing the company's process, for instance, may be appropriate if the auditor intends to rely on controls over the process, or the company uses complex proprietary models to develop an accounting estimate, maybe because it's related to a complex financial contract, or maybe for an allowance for loan loss reserves. But if the company's controls over an estimate are ineffective, then developing an independent expectation of the estimate may be appropriate. If an estimate has multiple components or multiple significant assumptions, the auditor may want to use different approaches for the individual components or for individual significant assumptions. And if there are relevant subsequent events or transactions that may have occurred, the auditor may want to use those to evaluate, may want to use that as the approach for determining the value of that accounting estimate. So let's walk through the first of the 3 approaches, which is testing the company's process. And I first want to start with evaluating the company's method in association with testing the company's process. The method a company uses to develop an accounting estimate and its corresponding inputs will typically depend on the nature of the estimate. For some estimates, like certain fair value measurements, the method may involve the use of a model or another valuation method. For example, one based on expected future cash flows. For other types of estimates, such as an obsolescence reserve, that method might be a calculation based on historical trends and other relevant data. The important thing is to remember is that the order is required to evaluate whether the method is in conformity with the applicable financial reporting framework. And that includes that the data is appropriately used and that significant assumptions are appropriately applied. Also, the order needs to consider whether the method is appropriate for the nature of the related account or disclosure, taking into account the auditor's understanding of the company and its environment. And as you all know, when it comes to a financial reporting framework, it may be prescriptive in terms of the method to develop an accounting estimate. In other instances, the framework may allow for alternative methods or provide guidance on how to apply a method, including the selection or use of assumptions or data. But it's important to keep in mind that the nature and extent of audit procedures to evaluate the method used by the company depends on the risk of material misstatement associated with the estimate, and that this will vary depending upon the type of the estimate or the process used to develop the estimate. So now let's turn to the second two bullets on this slide, data. The nature and extent of procedures to perform with respect to data depend on whether the data is produced by the company or from external sources. Generally speaking, the requirements in this area align with an existing requirement in AS 1105, which is our audit evidence standard. And that standard requires that for data produced by the company, auditors are required to test the accuracy and completeness of that information or test controls over the accuracy and completeness of that information and evaluate whether it's sufficiently precise for purposes of the audit. Now, for data that's from an external source, the auditor should evaluate the relevance and reliability of that data. And with that, this is the first CPE code I have of the day, code 330. Give you a few seconds to enter that in. Okay, moving on. So we've talked now about the method and data in association with testing the company's process, but I want to focus a bit now on developing an estimate and the assumptions that are used. So for assumptions, there are two aspects of the requirement. First, you want to identify the significant assumptions used by the company, and to do that, you should take into account a few factors: the nature of the estimate, including the related risk factors, the requirements of the applicable financial reporting framework, and the auditor's understanding of the company's process for developing the estimate. So said differently, the auditor wants to use his or her knowledge they've gained from the risk assessment process and other procedures performed to help identify significant assumptions. So you may be wondering, well, what is a significant assumption? What does that constitute? These are assumptions that are important to the recognition or measurement of the accounting estimate in the financial statements. And the standard provides examples of assumptions that ordinarily would be considered significant assumptions, including those that, and there's going to be four factors here, are sensitive to variation such that minor changes in the assumption can cause significant changes in the estimate. 2, are susceptible to manipulation or bias. 3, involve unobservable data or the company's adjustment of observable data. And 4, depend on the company's intent and ability to carry out a particular course of action. Now, I just want to point out that these are examples in the standard, and they're not intended to be an exhaustive list of all the attributes of significant assumptions. Facts and circumstances may dictate that you may encounter other factors that might inform your contemplation of something being a significant assumption. Now, I just want to turn to our audit evidence standard for a minute, AS 1215. The requirements for documenting the significant assumptions identified by the auditor are not new. And AS 1215 does set forth requirements for audit documentation, including a requirement that it contains sufficient information to enable an experienced auditor to understand the nature, timing, and extent, and the results of the procedures performed, the evidence obtained, and the conclusions reached. Consistent with that standard, auditors should document the significant assumptions they identified, as well as the rationale for why they were significant assumptions. But please keep this in mind. The auditor is not expected to document a detailed comparison of each assumption used in the accounting estimate to the examples of significant assumptions I just described, meaning those 4 factors I just described to you. So, once the auditor has identified the significant assumptions, the auditor is then required to evaluate them for reasonableness. And this is important both individually and in combination. So I want to go on to the next aspect of evaluating significant assumptions, evaluating the reasonableness of them, in which there are several requirements. First, the auditor should evaluate whether the company has a reasonable basis for the significant assumption. Recognizing what constitutes a reasonable basis for a significant assumption will depend on the nature of the assumption. For instance, if we were thinking about a volatility input to a Black-Scholes computation, a reasonable basis for implied volatility would differ from the basis for historical volatility. Some assumptions might be supported by detailed calculations or historical information specific to the company, like historical volatility, while the other assumptions might be based on industry or peer company data, maybe the use of peer companies and the determination of their volatility as an implied volatility for the company that we're looking at the significant input of volatility for. Here, the auditor thinks about whether the assumption is based on an analysis of relevant information or determined arbitrarily, with little or no analysis. Did the company consider available relevant evidence, regardless of whether it corroborates or contradicts the company's assumption? Now, moving on to the second consideration here. The auditor should evaluate if the significant assumptions are consistent with the following. And this is going to be a list of factors. Relevant industry, regulatory, and other external factors, including economic conditions, the company's objectives, strategies, and related business risks, existing market information, historical or recent experience taking into account changes in conditions affecting the company, and finally, other significant assumptions the company may have used in other accounting estimates. For example, assumptions used in multiple estimates, let's say a growth rate for a specific product line, should ordinarily be consistent with each other. There should be comparability or symmetry in the use of those assumptions if they're applied to a variety of accounts. It's important to keep in mind that in some cases, assumptions that are based on past experience and management's expectations may not be reflective of current market information or representative of expected future conditions or events. For example, changes affecting a company's industry may affect certain assumptions, such as those related to revenue projections or cash flow estimates. And I think the spirit of that is that history may not always be the best predictor or determinant of the future, so the auditor may need to have an eye or a contemplation towards prospective or forecasted information when thinking about these assumptions. Something else that I want to point out is the standard allows for auditors to evaluate the reasonableness of a significant assumption by developing an expectation of that significant assumption. In these circumstances, the auditor should have a reasonable basis for that expectation. In some cases, a significant assumption may be based on the company's intent and ability to carry out a particular course of action. The standard sets forth specific factors the auditor should take into account under these circumstances, and those considerations reside in paragraph 17 of AS 2501. So with that takes us through testing the company's process. And now I want to move on to the second of the 3 approaches, developing an independent expectation. Auditors may choose to develop an independent expectation of an estimate, and developing an independent expectation involves the auditor using some or all of his or her own methods, data, and assumptions to develop an expectation of the estimate for comparison to the company's estimate. The applicable requirements depend on the source of the methods, data, and assumptions used by the auditor to develop the expectation. So when the auditor derives assumptions or uses his or her own method in developing an independent expectation, the order should have a reasonable basis for the assumptions and methods used. Here you want to consider the nature of the estimate, the requirements of the applicable financial reporting framework, as well as other relevant factors. Now, if the order uses data or assumptions obtained from a third party to develop the expectation, the auditor should evaluate the relevance and reliability of the data and assumptions in accordance with AS 1105. Finally, if the order uses either data produced by the company, significant assumptions used by the company, or the company's method in developing the expectation, then the order should test the data, methods, and significant assumptions in the same manner we just discussed in association with testing the company's process. Orders may also choose to develop an independent expectation as a range of possible outcomes. In those cases, the order is required to determine that the range encompasses only reasonable outcomes in conformity with the applicable financial reporting framework and is also supported by sufficient appropriate audit evidence. So with that, I'm going to take us to our third and final approach to substantively testing an auditing estimate, which may include a fair value measurement, subsequent events and transactions. For some estimates, events or transactions occurring after the measurement date can provide sufficient appropriate audit evidence. The focus here should be on whether the evidence related to the subsequent event or transaction is, and I want to underscore this, relevant and reliable to the estimate. You want to think about whether there have been any changes in the company's circumstances between the event date and the measurement date, meaning from when the accounting estimate was measured through that intervening period when you're looking at those subsequent events or transactions as a form of audit evidence. As the length of time from the measurement date increases, the likelihood that the events and conditions have changed also increases. So with that, we've now covered the three approaches to substantively testing an accounting estimate. And I just want to move on to a polling question and an illustrative example. The company reported an allowance for loan losses, an ALL, that included a qualitative reserve component that was based on basis points assigned to various qualitative factors. Which of the following statements is true? A, the auditor was required to test the company's process. B, the auditor was required to evaluate the reasonableness of all assumptions related to the various qualitative factors. C, the auditor was required to evaluate the appropriateness of the method used by the company to develop the qualitative component of the ALL. D, all of the above. E, none of the above. I think I can advance now too. And it looks like you're ahead of me. You've already casted a number of votes. Give it a few more seconds for everybody to get their polling in.
It's stopped already. When you advanced it, it stopped.
Oh, okay.
Yeah, just keep going.
Okay. So the correct answer here is E, none of the above. With respect to A, there is no requirement to select the approach to test the company's process. Rather, the auditor should consider its understanding of it as it relates to the estimate in selecting the approach. With respect to B, the auditor must first identify those assumptions that are significant. Significant assumptions are those that are important to the recognition or measurement of the accounting estimate. Then the auditor is required to evaluate the reasonableness of the significant assumptions. With respect to C, the auditor is required to evaluate the appropriateness of the method used by the company to develop the qualitative component of the allowance for loan loss reserves when testing the company process, or if the auditor developed an independent expectation of the estimate using the company's method. Otherwise, as part of its risk assessment procedures and as required by paragraph 28 of AS 2110, the auditor should obtain an understanding of the company's information systems, including the relevant business processes that are relevant to financial reporting. This includes accounts that involve accounting estimates, the process used to develop the accounting estimates, as well as the models used, data and assumptions, and the extent to which the company uses third parties. So for instance, let's say specialists. So we're now going to move on to the second portion of this fact pattern. The auditor's approach to test the qualitative reserve component of the AL is to test management's process. So in this fact pattern, they're testing the company's process. The auditor performed the following procedures. They obtained and read the company's quarterly qualitative factors adjustments, including commentary for each factor. They focused on changes in the adjustments from prior periods. And they also read the company's and understood the company's ALL memo. They identified which of the qualitative factors were significant assumptions. They evaluated the changes in the significant assumptions in relation to the prior period, and for certain of those factors, certain external or internal loan data was obtained by the engagement team. And then finally, the company compared the company's reserves and ratios to those of peers, including the total collective reserve and other reserves to the total allowance for loan losses, and the total collective reserve and other reserves to total loans.
Just let it sit.
Okay. So were the auditor's procedures to evaluate the reasonableness of the significant assumptions sufficient to address the requirements in AS 2501? A, yes. B, no.
Just give it a
Yeah. Okay.
You can go ahead.
Okay, and with that, I'm going to close out the poll. Okay, so 69% answered yes. The correct answer in this case is no. In this instance, this was not enough, and this is why. Although the auditor performed certain procedures to evaluate the reasonableness of the assumptions by evaluating the consistency of the assumptions with industry information and historical experience, as required by paragraph 16B, the auditor did not perform procedures to evaluate whether the company had a reasonable basis for the significant assumptions it used and for the selection of assumptions from a range of potential assumptions. In other words, this is the 16A requirement of 2501. In other words, the auditor's procedures in this instance provided evidence that the assumptions were directionally consistent with relevant internal and external data and consistent with peer data, industry data, but not whether the company had a reasonable basis for the assumptions. And just so you know, this is a fairly frequent deficiency that we identify in connection with allowance for loan loss testing. Moving on, I want to provide you the second CPE code, 484.
We're down to 20 minutes in total. Okay.
And I want to move on to a different account now and a different industry. We want to talk about an inventory exercise. In the case of this inventory exercise, the company reported several types of inventory and disclosed in its financial statements that there were reserves recorded for obsolescence or slow-moving inventory based on assumptions about future demand and marketability of the products, new product introductions, and specific identification of items. The auditor's approach tested inventory reserves and they developed here an independent expectation by applying a historical write-off percentage to the total current inventory. The auditor performed procedures to test the accuracy and completeness of the historical write-off percentages, and the auditor compared its expectation to the company's reserve, and the variance was below tolerable misstatement. I'm going to open up the polls on this one. So were the auditor's procedures sufficient to address the requirements in AS 2501? close the polls. Pretty split here. The correct answer here is no. There are two concerns related to the auditor's procedures in this instance. But before I jump into those concerns, I want to remind you that in developing an independent expectation, the auditor should take into account the requirements of the applicable financial reporting framework and the auditor's understanding of the company's process, including the significant assumptions used by the company, so that the auditor's expectations consider the factors relevant to the estimate. So that being said, the first concern is that the auditor did not demonstrate that it had a reasonable basis for the method, because it did not demonstrate why developing the expectation at an aggregated level, again, an aggregated level, was reasonable, considering the company took into account several factors specific to each type of inventory in developing its reserve. Second, the auditor did not demonstrate it had a reasonable basis for the reserve percentage, because it did not demonstrate how the historical write-off reserve percentage took into account future demand of the company's products, which the company did take into account in developing its accounting estimate. So I'm at the end of my presentation, my portion of the presentation. I just want to provide you a few key takeaways. First, identifying significant assumptions such that the audit effort is focused on those assumptions that are important to recognition or measurement of the accounting estimate. When testing the company's process, addressing all applicable requirements in evaluating the reasonableness of the assumptions. And those requirements reside in paragraphs 16, 16A, and 17 of AS 2501 as applicable. When developing an independent expectation and using independent assumptions and methods, having a reasonable basis for the assumptions and methods used. And with that, I'm going to hand the presentation over to my colleague, Shirley Wee.
Thanks, Nick. So let's kick off this section on audits involving other auditors with a polling question. The other auditors' amendments are effective for audits of fiscal year ending on or after December 15th, A, 2023, B, 2024, C, 2025, or D, 2026. I'll give you guys a few minutes to respond.
If we get the question, is that one you want to answer?
Okay. And looks like most of you got it right, 2024. The PCAOB amended its standards to strengthen the requirements for planning and supervising audits involving other accounting firms and other individual accountants that perform audit work. Moving on to the next polling question. According to the 2023 Form AP data, what percentage of all issuer audits use the work of other auditors or refer to auditors? A, 6%, B, 16%, C, 26%, or D, 36%? And looks like most of you got it right, 16%. Yay. Challenges with coordination and communication with other auditor or refer to auditor can lead to misunderstanding of the nature, timing, and extent of work, and thus can lead to decrease in audit quality. To enhance the audit practice of all firms using other auditors, the board identified the following areas for improvement in the current standards. 1, applying a risk-based supervisory approach to direct the lead auditor's attention to areas of significant risk. 2, requiring the lead auditor to perform certain procedures when planning and supervising an audit involving other auditors, including, among other things, A, understanding whether the other auditors are in compliance with independence requirements, and B, understanding whether the other auditors has the knowledge, skill, and ability to perform the work. Okay, in this slide, you'll see an illustration of an audit under the amended standards. You have the lead auditor in the middle who is responsible for proper planning and supervision. The lead auditor includes both the engagement partner and other personnel from that firm. Lead auditor is replacing the existing term principal auditor. On one side, you have the other auditors who are members of the engagement team, but not under the direction and control of the lead auditor. When the lead auditor uses other auditors, the work performed must be supervised in accordance with Auditing Standards 1201, supervision of the audit engagement. The large majority of audits that involve other accounting firms will now fall under the supervision approach of AS 1201. So on the other side, you have refer-to auditors. Refer-to auditors are not members of the engagement team, but are public accounting firms that perform an audit of the financial statements of one or more of the company's business units and issues an auditor's report in accordance with PCAOB standards, to which the lead auditor makes references in the auditor's report. When the lead auditor divides responsibility for the audit, the lead auditor must comply with AS 1206, dividing responsibility for the audit with another accounting firm. AS 1205, part of the audit performed by other independent auditors, has been rescinded in its entirety. So on this slide, we have examples provided in adopting a release of who is and who is not part of the engagement team. The engagement team includes partners and professional staff employed or engaged by the lead auditor to perform audit procedures on the audit or assist the engagement partner in fulfilling their planning or supervisory responsibilities. Under the amendment, the lead auditor is responsible for the supervision of the engagement team. It is critical for the engagement partner to understand who is and not included in the definition of engagement team, as there may be changes for audits where the other auditors are supervised by the lead auditor under AS 1201. So as a reminder, other auditors are part of the engagement team. Okay. And we have a code word, 892. I'll give you guys a few minutes to input it into Conference IO. The code number is 892. Okay, that's 892. All right. And we have polling questions in the next 3 slides. So in this slide, the blank is responsible for carrying out proper planning and supervision of the blank. Is it A, lead auditor, other auditor, B, lead auditor, refer to auditor, or C, lead auditor, engagement team? I can give you guys a few more minutes. And looks like most of you got it right. The lead auditor and the engagement team. Some things to keep in mind as it relates to other auditors and the amended AS 2101 audit planning and AS 1201 supervision of the audit engagement standards. Under those standards, among other things, the lead auditor should determine whether the participation of his or her firm is sufficient for the firm to carry out its responsibilities of a lead auditor and to report as such on the audited financial statements. The lead auditor should obtain an understanding of the other auditor's knowledge of and experience in applying SEC independence requirements and PCAOB independence and ethic requirements by obtaining and reviewing a written affirmation as to whether the other auditor has policies and procedures describing how the other auditor determines its compliance with the requirements. A written description of all relationships between the other auditors and the audit clients or persons in financial reporting oversight role at the audit client that may reasonably be thought to bear on independence, and a written affirmation as to whether the other auditor is in compliance with SEC and PCAOB independence requirements. In addition, the lead auditor should obtain a written affirmation from the other auditor that its engagement team members possesses the knowledge, skill, and ability to perform the assigned task. The lead auditor should inform the other auditor the scope of work to be performed and obtain and review the other auditor's written description of the audit procedures to be performed. The lead auditor should determine whether any changes to the other auditor's planned audit procedures are necessary. And the lead auditor should determine whether the other auditor performed the work in accordance with the instructions by obtaining and reviewing written affirmation as to whether the other auditor has performed the work, including holding discussions with the other auditors, and specified audit documentation concerning work requested to be performed to determine whether the other auditor performed the work in accordance with the auditor's instructions. Okay, next polling question. In an audit that involves other auditors or refer to auditors, the engagement partner should determine whether his or her firm has A, participated sufficiently, B, supervised appropriately, or C, plan appropriately, taking into account the importance, risk, and extent of supervision. I'll give you a few more minutes to cast your votes. Looks like it's slowing down, and close it. And the answer is A, participated sufficiently. So, as mentioned earlier, in an audit that involves other auditors or refer to auditors, the engagement partner should determine whether the participation of his or her firm is sufficient for the firm to carry out their responsibility of a lead auditor and to report as such on the company's financial statements. So when determining whether participation is sufficient, the engagement partner should take into account the importance of the location for which an engagement partner's firm performs audit procedures, the risk of the material misstatement associated with the locations for which the engagement partner's firm performs audit procedures, and the extent of the engagement partner's firm's supervision of the other auditor's work. And last polling question. In an audit that involves other auditors or refer to auditors that play a substantial role, the lead auditor may use the work of the other auditor or refer to auditor only if that auditor is A, an audit firm, B, engaged in the practice of public accounting, Or C, register with a PCAOB? Okay. And looks like most of you got this right, register with the PCAOB. So in the next slide, we're going to walk through a couple of examples of deficiencies the PCAOB has identified when inspecting firms who perform audits involving other auditors. So in this example, the lead auditor engaged an outside accounting firm to perform inventory observation at one of the issuer's warehouses. Inventory was approximately 70% of total asset. But the firm did not obtain independent representation from the other auditor and did not include information regarding the participation of the other auditor in its report on the Form AP. So it's a reminder for firms to obtain independent representation and comply with Form AP requirements when other auditors are involved. And in this last example, we have the lead auditor engage an outside accounting firm to perform audit procedures primarily related to interim reviews. So the reminder here is to make sure that the lead auditor is communicating to the issuer's audit committee the name, location, and planned responsibilities of the other auditor. So with that, I'm going to turn things back to Tim.
All right. Well, thank you, Shirley and Nick. We really appreciate the information that you've provided. And looking at the time, we are coming up on the end of our session, and there have been a few questions that have come in, but we'll need to defer those. I will say that some of us will be around, and if you have a specific question, feel free to maybe approach us as it relates to that. But with this, we can conclude our session today, and I want to express my sincere appreciation to you for your attendance and your participation, and I hope you enjoy the remainder of the session today. So thank you very much.